Good afternoon, everyone. This is Dan Bird with the Daily Scan for Friday, November 15th from breakpointtrading.net. Uh, right on cue, options expiration was today. And as I talked about earlier this week, options expiration often is the opposite of what the market had been doing. The market had been going up, so I was expecting it to come down, and that's exactly what happened. So let's jump into it and take a look. Actually, before I do that, I'm going to actually open up the the Max Payne report, and we can compare it and see how close it came so far. Max Payne often will go into the next week, so it's not over yet, but we'll at least see, basically how close it came. I'll show that in a second. But let's first take a look at the market bias for today, the 15th, and you can see how it's continuing to roll over. So it's just steadily for the last week after the big rally during the election, and then this past week just steadily moving lower. Let me show you real quick how I do the market bias. So here's the market bias, the whole thing. So it's indexes, sectors, industries, relative charts, commodities, metals, and currencies. And anytime something changes, it gets highlighted. So if it goes from bull to bear, it gets a red box. If it goes from bear to bull, it gets a green box. And it's been mostly bullish, and all of these get rolled up. It's a short-term, medium-term, long-term, and all of these things, these three columns get rolled up into a single score, basically, which is a bullish score right now, 70%, so it's green, but it's coming down. So you can see on this little chart over here, it's a day over day, week over week. So it compares yesterday to and a week ago. And if both of those are lower, it's red. If they're both higher, it's green. And if one is different, it's neutral or yellow. And you can see we're starting to get more and more reds. But let me show you how I do this every day. I update this every day. It doesn't really take me too long to do it because in stock charts, I have a chart list called bias charts. And it's all of those that I just showed you. And I'm just going to go through the few from the top and just give you a sense for what it looks like. So what I want you to do is focus on what this upper right corner looks like. So when this pink one crosses over the blue ones, that's the 5 exponential moving average crossing the 21, that's a short-term signal. When the blue one crosses the red, that is a medium-term signal. And when the red crosses the dashed gray line, the 200-day moving average down here, that is the long-term signal. And when the 50 crosses the 200, that's called, I actually have it highlighted right here, that's called the death cross. So this little box right here, as long as that's green, then the long-term is positive. It's the day that one of these turns red, that will be a death cross. And the other ones will probably follow shortly after that. So that's why I kind of highlighted this box right here, because if one of these turns red and it gets a red highlighting like a box around it, like down here, that just means that we just had a death cross. So keep an eye on that. So let's take a look at just the top view. So focus on the upper right. I'm going to go through these pretty quick. So there's the S&P, there's the NASDAQ 100, actually the NASDAQ. There's the Dow Jones. There's the NASDAQ 100. Notice how a lot of these have already, the price has crossed the 21-day moving average, but the lines have not yet crossed. It will only take 1 or 2 more days. And remember, I said that options expiration or Max Payne can go into the first couple of days of next week. So this could actually move down and get a short-term down signal next week. But just look at how many of them, and then that line will drop dramatically if that happens. But look how many of these could get a short-term down signal just next week. So there's small caps. There's the New York Exchange. Here's the Russell 2000 heading down dramatically. Here is the Russell growth stocks. Here is value. This one's still up there. Transportation is still hanging in there. This one's starting to go up. Utilities. Utilities is the most defensive sector. So that's typically what happens when the market starts going down. Traders move into defensive sectors like utilities, which pays dividends. And that's actually moved up today. So that's what I would expect. Here's technology. These are the sectors. Technology, one more day, and that'll be short-term down. Communications is still hanging in there. Consumer discretionary is still up. There's staples. That's these next three are all defensive sectors. There's utilities going higher. There's healthcare just falling off a cliff. Here's energy. Energy actually had been doing pretty well. There's materials where gold is. There's industrials and financials and real estate. So just, real quick as I flip through these, there's semiconductors. Semiconductors already gave a short-term down signal. So the next one for semis is a medium-term down signal. It's heading there pretty quick. This is software heading down. Now, interestingly, for those that follow Tom Bowley and earnings beats, which I do, and I think he has some really great, he's the one that does the Max Payne report, which I'll show you in a second. He's got a great website. He does a lot of really good work. He put out an article a couple of days ago saying that software was the place to be. Software is just moving higher. It's very strong. And you can see what software has done over here. It's moved from here to here. So he's right. It has been very strong. But he put his article out right here on this bar. That is a shooting star, clear shooting star doji right there. That is a reversal candle. So that's when he put his article out, right? That the day that reversal candle came out saying that software is the place to be. So I don't disagree with his thesis. I just disagree with the timing. So I think software will be one of the strongest areas, but not right now. 2 down days right there. Here's clean energy, really just plummeting lower. Here's artificial intelligence, also moving down. Cloud computing, starting to roll over. Here's autonomous and electric vehicles. Here's cybersecurity. This is biotech. So this is just following what I showed you with healthcare. Looks similar to healthcare, but that's just the biotech industry group. There's home construction. It's given both a short-term and a medium-term down signal way back here. So the time to get out was way back here on the short-term down signal. Here's transportation. Transportation's actually hanging in there. There's insurance, not doing too bad. Here's banks and regional banks. So that's what I do. And that's the reason why when I go through this and update the market bias chart every day, I get a sense right away of what the market is looking like, where it's headed. Even before the signals actually trigger, I can actually see what the moves are doing well ahead of time. And for those that are subscribers, you can download the market bias spreadsheet right here with this download button, and you will get this in a much clearer view. And each of these symbols will have charts attached to them. You just click on them, and then you can go through those too, just like I did. So anyway, that's where we're at. Continuing to go down. Max Payne is holding true to history. Here's the Max Payne report. This is from Tom Bowley. There's Tom Bowley right there. And this is the one from this week. So let's compare his Max Payne report. And let me see if I can put this in the corner somehow. Okay, so there's Max Payne. And then I'm going to bring up a chart over here. And let's start with the SPY. Let's look at it this way. So there's the SPY. And now if I can find his report again. Let's see, here we go. So I'm going to actually move this a little bit over as well. Sorry for moving this stuff around, but I want to show both of them together. Okay, so here's the SPY. right there. You can see 585 and Max Payne SPY said 559. So it's not down to 559, but it's going there quickly. All right, we're going to look at the top ones for the indexes. Well, we'll look at a couple of the individual stocks that, and like I said, when I talk about Max Payne, very rarely does it ever get to the actual price. And if you want to understand how Max Payne is done, look at the video from a couple of days ago. So SPY, the target was 559. And remember, Max Payne carries over into the first couple of days of the next week. So we're at 585. 559 was the target. It's getting pretty close. 559 would be down here. So it would have to drop through the 50-day and into the cloud. The Qs, this is the NASDAQ. NASDAQ is at 496. Max Payne was 480. So it's heading there as well. 480 is right down here. Again, below the 50-day, actually below support, but it could get close to that level. And IWM for the Russell 2000. IWM is at 228 and the target was 218. So not too far to go. 218 would be right down here, again, just below the 50-day. So all of those to hit the Max Payne target number would have to go down to around the 50-day moving average, which could happen in the next couple of days, next week. As I said, it rarely actually gets to the number, but it gives you a directional cue. So all of these numbers over here are from last Friday, the 8th, so 1 week ago. That's when these started. Max Payne, of course, would be lower now because the price is lower. But as of last Friday, you can see we're looking at the Russell, 238 was the price. 238 was way up here, almost at the high. So that's when Max Payne said 218. And we're heading towards it rapidly, and probably Max Payne will have come up some because there's probably lots of calls that have already been closed and puts starting to be bought. So Max Payne, the equilibrium point, will start to move up from there. So it's a pretty good indicator many times. So let's look at Tesla. Look at a couple of these. There's Tesla right there. 242 was Max Payne. That has to go a long way. So you can see it would had to have fallen 24%. So 321 was where that started, and it's actually back pretty much to that. NVIDIA, which reports next week. NVIDIA is starting to move down, but I don't think there's any way it's going to get to 115. Palantir actually, I think, went up today. Yeah, Palantir went up dramatically, so that one won't make it. Amazon is at 202. Max Payne was 178. It would have to drop down here, probably below the 200-day. I don't think that's going to make it either. But in general, you can see that directionally, for most of them, not all of them, directionally, it's pretty accurate. So 537 for Meta. It's at 554 right now. So it actually could hit it. It could actually hit Max Payne in one more day. That's right there for Meta. Netflix, look at the Magnificent Seven. Netflix has barely moved down, so that's probably not going to hit the target there. Microsoft is at 415 right now, and Max Payne was 401. That's right down here. Possibly, but it's got a lot of support. That's actually right at support right here. So that potentially could make it there. And then finally, Apple. Apple's at 225. Max Payne was 215. So that would have to go down all the way down to here. Probably not. So anyway, that's where it looks at. If you look at the indexes, I think they were pretty accurate. And that's mostly what I look at. I just want direction. I don't really care about the exact numbers over here. I just want to understand directionally where the market might head. So that's Max Payne. Let's now take a look at the NASDAQ. Actually, let's go back to the website, to the homepage, and we'll look at the NASDAQ right here. And what you can see is, as I said yesterday when I showed this, It's likely going to come down to the support line, and we'll have to see if it's going to, that will actually be support. And it clearly wasn't. It actually opened right at it and fell right through. And then it fell through the 21-day moving average as well. And this highlighted area is the open gap. So it fell into the gap, and likely Monday or Tuesday or both days, it'll probably fall through the gap and probably be heading for this 19.9 support level right down here. That's where I think it might be headed. Now, let's look at this a different way. One way I always like to look at long-term charts like this is using the Keltner channels. I'll explain what they are. So in stock charts, it allows you to set up these little buttons for different ways, different chart styles for looking at a single ticker symbol. So this is my 1 year chart right here, but I have one for Keltner channels. And this basically shows you the average true range. So it puts a plus and minus for the average true range using, in this case, the 21-day moving average, which is that dark blue line right there, as the reversion to the mean. The green shaded area is one average range, how much the stock normally travels in 1 day. So one above the mean and one below the mean. The blue area is 2x the average range, and the red area is 3x the average range. And those are extremes. You can see where we actually got into the 3x right here, almost got to the 4x. You can see back here it actually did get to the 4x. But when it gets to an extreme, many times it will pull back to the mean, and sometimes it will fall right through the mean. So if we look at this area here, where it hit the 3x, we should have been expecting it to come back to the mean, which is what it did. It actually fell through it. So we'll very likely, just like we did back here in July, went into the 4x area. The mean was down here. So if you look at this candle, this red candle right here, it's very similar to this red candle right there. In fact, these groupings of how price reacted to that extreme are very similar to these groupings over here of how price reacted to that extreme. So it came down a little bit, went sideways, came down a little bit, went sideways, and then started falling. So first it fell right through the 21, through the mean, exactly like we did right now. So what can we expect? Well, probably similar to what we have over here. And I think we probably remember the 19.9 number that I showed you before. That's right down here in between the 2x extreme and the 3x extreme, right down there. And the Bollinger Band is the orange dash line right below it, also right at the 3x level. So I think we are likely coming down to that 19.9 area, and we may do that fairly quickly if max pain continues into Monday or Tuesday. All right, that's what I wanted to show you there. So let's take a look now at the daily scan, the worksheet. So we got stopped out of a couple today. And one thing that I want to point out, and this is really important, and one of the subscribers mentioned it on the YouTube channel. If you go back to yesterday's and look at the comments, he said, I downloaded your spreadsheet. That's this one. He said, I've been trying to use spreadsheets for other things. This is the cleanest way I've seen to use it for trading. He said he put all of his old trades in and was able to see right away where he was making mistakes. And that's the purpose of this. The goal of this is not necessarily, I mean, eventually it's to make quite a bit of money, but more importantly, it's to protect your principal. So for risk management, and that everything, I've said this over and over again, I'm not predicting what's going to happen. I just use all of this for risk management. So right now we got stopped out of WLDN, got stopped out yesterday. Today was Google was stopped out. And yesterday was Raytheon and Powell were stopped out. And the day before was Sentinel and WLDN. And then Uber was way earlier. Uber, we only gave it 2 days before earnings. That was a mistake. So I actually put things over here of what I'm seeing if when I get stopped out, especially when there's a loss. But you can see Powell was actually a 13% gain. And the losses were pretty small. So the losses were less than 5%. And in some cases, 2% or lower. And that's what you want. That is the goal. You want the losses to be small, and you want the winners to run as long as they possibly can. And you can see overall, with these that have been stopped out, we're at 0%. We haven't lost any money. So let's take a look at the ones that we're still in. So DocuSign right there, still looking okay. It is pulling back. And like I mentioned, I would love to see it pull back and then start to move higher again. So now the 21-day moving average is now above our stop price. This may come back to the 21, and every day the 21 will continue to move higher. So right now it's at 74 or 77. It probably is hopefully going to be around 75, and maybe DocuSign will start to move higher again. And if that happens, we will move our stop up so that we will continue to increase our profits. Here's Intel that we just got in yesterday. It's basically flat, actually a little lower than our entry, but this is one that I put the stop price down here below the 50-day, further down, because I think this one may be a buyout candidate at some point. And if the whole market turns around, I think Intel's going to do well as well. And actually, you can see down here the volume, even on this little pullback right here, the volume has been very light. Okay, so the next one is Oracle. Oracle also pulling back. 21-day is moving above our stop price. Would love to see it move to that and then start moving up again. And finally, VRT, same thing. It actually pulled back today, but then started to move up. Again, 21-day is above the stop price. So all of those actually look pretty good. We've got 11% gain on DocuSign. Intel, of course, that's one that we might just hold for a while, even if it goes down quite a bit. I mean, if it goes all the way to the stop price right now, it would be a 9% loss, which is higher than I usually like to see them. But this is one, I don't think Intel's not going out of business, and it's such a low price right now that I think eventually it's going to go higher. So the only one that really, Oracle, if it gets stopped out, is a 1.7% loss. But that's the goal. That's what you want. Now, if we want, let's look at some of the ones that did get stopped out. Google right here, and I'll make a comment about that. So Google went down below the 21-day. It got stopped out right there, but it's hanging around right at the 21-day. So that could be the point where it starts to move higher. Notice the crossover of the PPO or the MACD up here. Long-term MACD crossed over as well. So that's an indication that it's got weakness. And I actually put a note over here. It's got a weak AD line. It's got a weak peer group and weak money flow. Again, if we look at Google again, you can see on this one here, so it's below 0 for its peer group. So that means it is underperforming its peer group. The AD line, accumulation distribution line, is moving down, and the PPO is crossing over up here. So there's some signs of weakness, and we want to try to avoid mistakes in the next ones. So that's why we keep track of them. Now let's look at Powell, because Powell had been doing really well. We would have done fantastic if we had sold out here, but that's not the goal. The goal is to try to let our winners run as long as possible. I would encourage you to go read right on the website. If you go to the books page, go read The Best Loser Wins, this book right here. That's basically what they talk about. Why most traders are wired to get out, to stay in losers as long as possible, and to get out of winners as early as possible. Get out of winners right when they first started making a gain, rather than staying in it and riding it all the way up. Now, having said that, this is quite a bit below the stop price. So I'm really glad that we got stopped out up here. We got stopped out at 294, and it's at 278 right now, down 7% today. If we look at this one, and it was funny, a subscriber said, I think you got into Raytheon just to teach us a lesson. Well, all of these are teaching a lesson. Hopefully, everything you do in trading teaches you a lesson. It's always different. Nothing ever looks the same. But you can see right there, our stop price was down here at 121. This started dropping through yesterday. It was taken out. It's all the way down to 118 right now. So the point I want to make, and this is actually could be support, so we'll see if it starts to move back up again. And if these move back up and give us another signal, we'll get right back into it. But the point I want to make here is that if this continues to move down, and we'll look at one that did, WLDN right here. So it hit the stop price right there, and 2 days in a row now. It's actually below the 50-day now. How many times have you bought something thinking that it's a perfect setup? It actually wasn't perfect because the MACD PPO is actually weak, very weak up here. Went below zero, so it's confirming the downtrend now, but it was weak before that. Actually, even in this uptrend, it was coming down, so that's a negative divergence, which I didn't pick up on when we got into it, and I should have. So next time I'll know. But when you get in thinking that looks like the perfect setup, perfect time to get in, and if you have the mindset that you want to be right, that's what the Best Loser Wins book will explain, that it can be deadly. Because then when it turns around, you're thinking to yourself, well, I knew I was right, so it's got to turn around. It's got to start coming back. Look at the volume on the day that it went up right there. It's huge volume. So I know it's going to turn around, but it just keeps going lower and lower and lower until it gets to a point where it doesn't even make any sense to take such a big loss to get out. You might as well just stay in and hope someday it comes back. You want to change that mindset. You want the mindset that says, I will not tolerate stocks that go down. I will no longer tolerate stocks that go down. And in this particular case, we got stopped out for a 4.3% loss, but the loss would be much bigger if we had not had that stop in place and we had just continued down. So we'd be down, I don't know, we got in at about 47, I think, 46. And right now it's down to about 41. So that's almost a 10% loss right now, instead of just a 4% just by placing your stop and getting out. So that's the point of this whole exercise. Let your winners run. And at some point, I don't know when that will be, but at some point, the whole market will turn around. It might be after next week, who knows? And right now, there are very few that are hitting the screens, the scans. In fact, only one or two every day hitting the scans, and they actually don't even look very good when I look at them. So that's what happens. If you set stops like this, then your stops will automatically take you out when the market starts to move lower. And when the market starts to move higher, there'll be more and more that hit the scan. There will be more candidates, more opportunities. You'll get into them at the right price, and then they will continue to go up, and they'll pull back and keep moving up and not hit the stop. And pretty soon we'll have a whole bunch of them up here with nice gains. And that's the goal. Let your winners run and cut your losers early. That's the way that you make money in the market. You can see the ones up here. I'll show you another great example, Zeta. So these up here were pending trades because we put them on the watch list because they were too close to earnings. So we didn't get into them. But if we look at Zeta, Zeta was this pink vertical line. That's the time it hit the scan right there. Pull back a little bit, but our stop would have been down here, so it wouldn't have been taken out. It went way up here, and we moved our stop up to there. It would have been stopped out right there at 32.50. But look where it is now, 17.50. You would have lost more than half, because this went all the way up. Well, we got in probably right here at 28 or so. I can actually look at it and see. So on Zeta, we didn't get in. We would have got in at 28.50. But now it's at 17, so would have been a huge loss. But by setting our stop, if we had moved this up here to the active trades, we would have been stopped out at 32.50. That would have been a 14% gain instead of almost a 50% loss. If we look at Affirm, now Affirm is actually starting to move back up again. So we might actually consider getting back in to Affirm. But this is one we didn't get in because it was so close to earnings, but it never came back to our stop price. So that actually would have been a good one to be in. Upstart, another one that had a 50% gain. So this would have been the buy point right there. We didn't because it was so close to earnings. Went way up here and then pull all the way back. Now it's sitting right at gap support. So Upstart might be one that will start to move higher if the whole market starts moving higher. And that might happen next week. So this is one that we might still get back into again. But the point that I wanted to make, and it's made beautifully with Zeta, is get in early enough, let it run higher, move your stops up, and hopefully move it up so that you're either at break even or making a profit. And if it gets stopped out, you should think of that as a good thing. You shouldn't think of that as you failed or you made a bad decision. You didn't. You didn't make a bad decision. You made a decision, and it went up and got stopped out with a 14% gain instead of a 50% loss. So that's the point of this exercise. That's hopefully what I'm teaching everyone, is how to do this and identify good opportunities. So that's it for tonight. Thanks everyone for watching. Have a great weekend, and we'll pick it up again on Monday. Thank you.